The shooting star at top is a pattern observed in the stock market that signals a potential reversal from an uptrend to a downtrend. This pattern occurs when, after a period of rising prices, the market opens and prices surge to a high, but then they fall back and close near the opening level. The result is a candlestick with a small body and a long upper shadow, resembling the shape of a shooting star in the night sky. Heeding the warning of the shooting star at top is crucial for investors. It indicates that, despite buyers pushing the price up during the trading session, sellers managed to bring it down close to where it started. This suggests a weakening of the prior upward momentum and potentially the start of downward pressure. For those actively involved in the market, recognizing this pattern can be a signal to consider adjusting their investment strategy, such as taking profits from long positions or preparing for a potential downtrend. In conclusion, the appearance of the shooting star at top pattern serves as a warning for investors about a possible change in market sentiment from bullish to bearish. Paying attention to such indicators while considering other market factors and analyses can aid investors in making more informed decisions and managing risk more effectively. The thrusting pattern is a term used in technical analysis that refers to a specific chart pattern observed in financial markets. It is identified during a downtrend and is considered a bearish continuation pattern. This means that when this pattern appears, it often indicates that the current downtrend in the market is likely to continue. Introduction to the persistence of the thrusting pattern. The thrusting pattern retains its significance across various market conditions due to its ability to convey investors' sentiment. Despite fluctuations in market dynamics, this pattern consistently points towards a continuation of the existing downtrend. Its persistence can be attributed to the psychological aspects of trading, where investors' reactions to certain price movements create repeatable patterns over time. Understanding how the thrusting pattern forms is crucial. It typically occurs after a period of selling, which led to a downtrend. Then, a candlestick with a small body appears, implying indecision or a potential reversal in market direction. However, the pattern is completed when another long candlestick follows, thrusting into the body of the previous one, but not completely erasing its losses. This demonstrates that despite an attempt to push the prices up, selling pressure remains dominant, suggesting that the downtrend is likely to persist. In summary, the thrusting pattern is an important tool for technical analysts and investors, offering insights into market trends and potential future movements. Its recognition stems from a deep understanding of market psychology and the continuous patterns it forms, making it a pivotal aspect of technical analysis. Identifying the thrusting pattern involves recognizing a specific formation on the price chart during a downtrend. This pattern is characterized by two key candlesticks. The first is a long black or red candlestick which signals a continuation of the downtrend. Following this, there is a white or green candlestick. The second candlestick opens lower than the close of the first candlestick, but closes well within the body of the first candlestick, yet it does not surpass the midway point of the first candlestick's body. This positioning suggests that, despite a brief pushback from buyers, the sellers retain control of the market. The pattern is seen as a bearish continuation, indicating that the downtrend is likely to persist. Traders often look for this pattern as a signal to potentially enter into short positions, anticipating further declines in the price. Recognizing this pattern requires an understanding of candlestick charts and an ability to discern subtle shifts in market dynamics that suggest a continuation of the existing trend rather than a reversal. Thrusting is a chart pattern observed in financial markets which signals the continuation of a bearish trend, meaning that the price of an asset is expected to continue decreasing. This pattern typically appears during a downtrend, serving as an indicator for traders and investors about the prevailing market sentiment, which in this case remains bearish. Understanding market sentiment is crucial for making informed investment decisions. It refers to the overall attitude of investors towards a particular market or asset. Positive sentiment indicates bullishness, where prices are expected to rise, while negative sentiment indicates bearishness, with expectations of a price decline. The thrusting pattern helps in deciphering market sentiment by showing that despite attempts at recovery or bullish movements, the underlying sentiment remains negative and the downtrend is likely to persist. Recognizing these patterns allows investors to align their strategies with the prevailing market trend, ensuring they are better positioned to manage risks and capitalize on potential opportunities. The thrusting pattern is recognized in the context of a downward trending market and signifies a potential continuation of this trend. Essentially, it acts as a signal to investors that the current downward momentum in prices might persist. To comprehend the nature of this pattern, visualize 2 consecutive days on a stock chart. On the first day, there is a long red candle indicating a significant drop in price from the open to the close. The second day begins with a price gap lower, but then reverses to close within the body of the previous day's candle, yet not surpassing its midpoint. This partial recovery suggests that while buying interest emerged to push prices up from their lowest point of the day, it was not strong enough to change the overall downward direction of the market. The presence of this pattern, particularly in a market that has been trending down, suggests that sellers remain in control and the bear market is likely to continue. Investors watching for this pattern use it as a cue to possibly maintain or enter bearish positions, anticipating further declines. Confirming the signal in the context of a thrusting pattern in technical analysis involves observing specific market indicators and behaviors following the formation of this pattern, especially in a downtrend. The thrusting pattern is considered a bearish continuation pattern, indicating that the current downtrend is likely to continue. To confirm the signal of a thrusting pattern, one should look for high trading volumes on the days following the pattern's formation. High trading volumes signify that there is substantial interest in selling, reinforcing the continuation of the downtrend. Additionally, seeing the price move below the low of the thrusting pattern would provide further confirmation. This price movement suggests that sellers are still in control and that downward momentum is building. Another critical aspect is the observation of the overall market trend and any significant news that might affect market sentiment. The confirmation of a bearish continuation through a thrusting pattern must align with broader market indicators. For instance, if the broader market is in a downtrend or if there is negative news that could impact investor sentiment negatively, these factors would support the continuation of the downtrend signaled by the thrusting pattern. In summary, to confirm the signal indicated by a thrusting pattern, investors and analysts should look for high trading volumes following the pattern's formation, a downward price movement below the pattern's low, and consider the overall market trend and significant news events. These elements together provide a more robust indication that the bearish trend is expected to continue. In discussing the thrusting pattern, which is a bearish continuation pattern in a downtrend, it's crucial to address the reliability of the signal it offers to traders and investors. The thrusting pattern occurs after a noticeable downtrend, signaling that the bearish sentiment might persist. It is characterized by a particular configuration of candlesticks, typically appearing in the chart as a small-bodied candle followed by a larger one, with the second one not fully engulfing the first. This setup suggests a struggle between buyers and sellers, where neither gains full control, but the bearish trend is likely to continue. The reliability of the thrusting pattern as a signal can vary. Several factors influence its predictive value, such as the volume of trading during the pattern's formation and the market context in which it appears. Generally, higher trading volume during the establishment of the pattern suggests stronger conviction among traders, supporting the pattern's bearish signal. Additionally, if the pattern forms after a pronounced downtrend, its significance as a continuation indicator is heightened. However, it's equally important to consider other market indicators and analysis techniques to validate the signal provided by a thrusting pattern. Combining multiple indicators can offer a more comprehensive market outlook and lead to more informed trading decisions. In essence, while the thrusting pattern can indicate the continuation of a bearish trend, traders should evaluate its reliability by examining trading volume and the broader market context. It serves as a piece of the puzzle which, when put together with other analytical elements, can help depict a clearer picture of market sentiment and potential movements. Thrusting is a bearish continuation pattern seen in financial markets during a downtrend. This pattern suggests that while there might be some buying interest, overall sentiment remains negative and the downtrend is likely to continue. The thrusting pattern forms when a candle with a small body is followed by a longer candle that does not fully eclipse the previous one. When we integrate this pattern with other technical analysis tools, we enhance our understanding of market movements. For example, using moving averages can help confirm the trend, while oscillators like the relative strength index may indicate whether the asset is overbought or oversold. Combining the thrusting pattern with these tools, we create a synergy that provides a more holistic view of market trends. This synergistic approach allows traders to make more informed decisions based on a confluence of indicators, rather than relying on a single pattern. It helps in assessing the strength of the prevailing trend and in identifying potential reversal points with greater accuracy. By understanding how these tools work together, traders can better navigate the complexities of the financial markets. The pattern referred to as thrusting is recognized in the realm of technical analysis as a bearish continuation pattern, typically observed during a downtrend. Initially, the market shows a long black candle followed by a white candle. The white candle opens lower than the previous day's close but closes within the range of the black candle's body without surpassing its midpoint. Despite the white candle's attempt to push upwards, the closing within the black candle's body signals that bearish sentiment remains strong and the downtrend is likely to continue. Navigating the pitfalls associated with the thrusting pattern requires careful observation and analysis. Investors should watch for the pattern to fully form before making decisions, as premature action can lead to misinterpretation. It's also crucial to consider additional market indicators and trends, since relying solely on one pattern might not provide a complete picture of market movements. By understanding the context in which the thrusting pattern occurs and combining this knowledge with other analytical tools, traders can mitigate risks and make more informed decisions regarding their investment strategies. In the context of a bearish continuation pattern known as thrusting, the strategic applications of this pattern in a downtrend are crucial for investors to understand. When a thrusting pattern occurs, it signifies that even though buyers attempted to gain control, the sellers maintained their dominance, indicating the potential for the continuation of the downtrend. Recognizing this pattern allows investors and traders to make strategic decisions such as preparing to sell the asset, setting tight stop losses if they are already in a long position, or looking for other signals to confirm the continuation of the bearish trend. It is also an opportune time for reviewing portfolio allocations to ensure that they are aligned with the anticipated market movements. Understanding and applying the insights gained from a thrusting pattern can help in mitigating risks and capitalizing on the bearish market momentum. The thrusting pattern is recognized as a bearish continuation pattern found within a downtrend in market charts. This pattern effectively signals that the current downtrend is likely to continue. It consists of two candlesticks. The first is a long black candlestick that is followed by a smaller white candlestick which closes within the body of the prior black candlestick but does not surpass its midpoint. The appearance of this formation suggests a temporary pause in downward price momentum rather than a reversal. The second candle's inability to push beyond the midpoint of the first candle reinforces the strength of the existing downtrend. In exploring variations of the thrusting pattern, it is important to note that slight differences can significantly impact its interpretation. For instance, if the second candlestick closes beyond the midpoint of the first but does not fully surpass its opening price, this variation may suggest a slightly stronger bearish sentiment, implying that sellers are gaining more control. Another variation to consider is the depth of the second candlestick's penetration into the first. A deeper penetration nearing the midpoint might hint at a weakening of bearish momentum, whereas a shallow penetration reinforces bearish strength. Overall, these variations in the thrusting pattern offer subtle cues about market sentiment and momentum. They require careful analysis as they can provide traders and analysts with valuable insights into the continuation of trends and potential points of resistance or support. Understanding the nuances of these patterns aids in making more informed decisions in the context of market analysis and trading strategies.